The cryptocurrency market is incredibly volatile, and the sheer quantity of different assets and trading options provides a wealth of opportunities for astute traders. Though blue chip cryptocurrencies have demonstrated a long-term bullish trend, this is rarely without interruption. Indeed, most cryptocurrencies experience extended periods of decline during a bear market and can even draw down in value in a bull market. Because of this, traders opt to trade on the short side, predicting which cryptocurrencies will decline in value and netting a potentially handsome profit if correct. Given that it is not uncommon for cryptocurrencies to lose upwards of 99% of their value during a bear market, shorting can be an incredibly lucrative endeavor, provided that it is executed correctly. Nonetheless, many cryptocurrency investors are unaware of how to profit from a declining cryptocurrency. And with that in mind, we'll look at 7 methods that traders use to short a cryptocurrency. These are listed in order of difficulty, starting with the easiest and moving to the most difficult, so timestamps are down below. So if you're new to trading in crypto, consider sticking with the simpler options until you've got a good grasp of things. With that said, my name is Trevor with CMC. This is not financial advice whatsoever, and let's dive right in. First, let's start with trade, short, inverse, and down tokens. So a short, also known as inverse or down tokens, are by far the simplest way to profit from a declining cryptocurrency. These tokens are designed to move in the opposite direction to an underlying cryptocurrency. So for example, you might have a short token designed to track the price of Bitcoin. If Bitcoin's price decreases, the short token's price will move in the opposite direction. It'll increase, and this allows short token holders to profit when the associated asset is declining. Vice versa, if the price of the associated asset increases, the inverse token will lose value. These use a variety of mechanisms to track and invert the price of an associated asset, generally using a combination of Oracle price feeds and smart contract logic to track the price of an associated asset and modify the token price to provide holders with a negative 1x exposure to the price change. Inverse tokens are also available in leveraged flavor. These provide leveraged exposure to the inverse of an underlying asset's price movement. So for example, if Bitcoin loses 10% of its value, then a 3x Bitcoin bear token would gain 30%. These generally use a rebalancing system to ensure that they maintain the correct exposure to the underlying asset at the expected leverage over time. Short tokens can typically be bought and sold on both centralized and also decentralized exchange platforms, just like regular tokens. They do not need to meet margin or collateralization requirements and also do not have liquidation risks. Unfortunately, just a handful of short tokens currently exist, and most suffer from limited liquidity. Because of this, few cryptocurrencies can be shorted in this way. Binance is currently one of the few platforms to support down tokens. Next, let's talk about prediction markets. So cryptocurrency prediction markets are platforms that allow users to wager on the outcome of future events, such as the Bitcoin price reaching $100,000 by December 31st of 2024. These platforms provide an array of markets that users can participate in and also decide whether they agree or disagree with the outcome specified in the market details. So consider this example. The price of Bitcoin will be below $20,000 by midnight on July 1st of 2023. Users can choose if they agree with this prediction by buying yes shares in the market or disagree with the prediction by buying no shares in the market. And the price of each share depends on the ratio of participants on each side. For a simplified example, if 30% of the participants agree with the outcome and buy yes shares, the price of a yes share might be around 30 cents, reflecting the perceived 30% chance of Bitcoin's price being below $10,000 by the end of the year. Conversely, the price of a no share might be around 70 cents, reflecting the 70% of participants who disagree with the prediction and believe Bitcoin's price will be above 10% by the specified time. This dynamic pricing allows market participants to express their belief in the likelihood of the outcome and potentially profit from it if their prediction is correct. Once the specified time and the date of the market are reached, the market is automatically resolved and those holding winning shares will win. Assuming they are paid 30 cents per share, they would then be paid out 70 cents per share, ignoring any fees, while the losers would lose their entire wager. Now let's talk about contract for difference. A contract for difference, or CFD, is a powerful financial instrument that allows traders to capitalize on cryptocurrency price movements by going either long or short. As the name suggests, CFDs are financial contracts that pay the differences in the settlement price between the opening and closing trades, hence contract for difference. Essentially, they allow traders to profit from the price movements of an underlying asset such as cryptocurrency without actually owning the asset itself. This makes them suitable for traders that don't want to deal with the complexity of trading, managing, and/or storing of cryptocurrencies. And this makes cryptocurrency trading more accessible to those with a limited starting capital. CFD trading is a relatively simple way to trade directional price movements. So, for example, if you believe Bitcoin's price will fall, then you'd want to sell a Bitcoin CFD. Let's say that you sell one Bitcoin CFD at $29,000, and then the price of Bitcoin falls to $25,000, and you want to exit your position to lock in your profits. You then close your position, buying the CFD back and locking in the $4,000 difference as profit, and this would probably be a bit less with fees. Conversely, if the price of Bitcoin is above $29,000 by the time that you close your position, you'd incur a loss equal to the closing price minus your entry price. Cryptocurrency CFDs are typically traded through online brokerage platforms and CFD providers. In most cases, these brokers will also provide access to a broad range of financial markets. Today, there are dozens of cryptocurrency CFD trading platforms, and some of the best known include eToro and also IG. Now let's talk about binary options. Cryptocurrency binary options are simplified financial derivatives that allow traders to make a prediction on whether they believe an asset will go up or down in value by a specified time and date in the future. In binary options trading, you predict whether an asset's price will rise or fall within a set time. If correct, you receive a fixed payout, and if wrong, you lose your investment. Traders looking to profit from the decline of cryptocurrency would execute lower options. These provide traders with a fixed payout when the option expires if they are correct in their prediction. This kind of option is frequently referred to as a high-low option, and there are dozens of binary options trading platforms supporting most popular cryptocurrency pairs. Binary options are different from typical vanilla options in that they are simply all-or-nothing trades. Binary options are usually European style, hence they can typically only be exercised at expiration, unlike American-style vanilla options, which can be exercised at any time prior to expiration. Some more advanced cryptocurrency traders may choose to trade regular options since they provide increased flexibility and can facilitate more complex trading strategies. Now let's talk about margin trading. Currently, one of the most popular ways to trade cryptocurrencies on the downside, margin trading allows traders to borrow funds from a third party, such as an exchange or liquidity provider, to open larger positions than their balance otherwise allows using leverage. The way it works is simple. To borrow funds, you need to hold a certain amount of funds in your margin account. Then you can borrow up to an agreed amount from the lender to open your position. This could be up to 100x your margin in some cases, allowing you to open positions much larger than simple spot trading. This method amplifies potential profits but also potential losses, since your margin will be used to repay the lender if your position runs too far into the negative. In return for borrowing funds from the broker or other lender, you'll typically need to pay margin interest, which is deducted from the profits when the trade is closed. Margin trading can be used to profit from a declining cryptocurrency through the process of short selling. The way it works is simple. If you expect a cryptocurrency to fall in price, you can borrow $10,000 worth of the asset from your broker before selling it immediately. If the asset then declines in price by 20%, you can then buy the same amount back for $8,000, repay your loan, and pocket the difference as profit. Most cryptocurrency exchanges will offer a simplified leverage trading interface to enable you to short cryptocurrencies using margin trading, keeping the mechanics of buying the asset, selling it, rebuying it, and repaying back the loan behind the scenes. Now let's talk about perpetual futures. Cryptocurrency futures are a type of financial derivative contract that entitles the holder to buy or sell an asset at an agreed price at an agreed date. Most cryptocurrency derivatives trading platforms offer a special type of futures contract known as a perpetual future. Unlike standard futures, perpetuals can be settled at any time, allowing traders to make directional predictions about the market and exit their position whenever they like. This provides increased flexibility and reduces barriers to entry by making futures trading less complex. Perpetual futures, or perps, as they're also commonly known, are a staple among experienced cryptocurrency traders due to their unique properties. securities. Perpetual futures allows traders to go long or short in their chosen market. They are leveraged positions, enabling traders to increase their exposure to the market when working with limited capital. Some exchanges and markets can support up to 100x leverage. To open a short position using cryptocurrency perps, you typically select the sell or short option on your chosen platform's trading interface. The exchange will then sell the contract and initiate a short position. To lock in profits or accept any losses, the trader would then need to buy back the contract and click the close option to lock in their profits or loss. When trading perpetual futures, traders should be aware of the unique fees associated with this type of contract. These include the standard maker or taker fee, as well as a funding rate, leverage fees, and in some cases, a settlement fee. Now let's talk about DeFi short selling. As we previously touched on, it's possible to use margin trading to easily short sell a cryptocurrency to profit from its decline. This involves taking out a margin loan and then opening a short position on a cryptocurrency via a broker or margin trading platform. DeFi short selling is a very similar, albeit slightly more involved process. The concept is nearly identical in that you borrow the cryptocurrency that you want to short, sell it, and then rebuy it at a later date to pay off your loan. But instead of using a broker, you take out a loan using one of the myriad DeFi lending platforms. So here's how it works in practice. Number 1, select the cryptocurrency that you want to short. And number 2, borrow X amount of the cryptocurrency from a supported open lending platform. Then 3, sell the cryptocurrency on a centralized or decentralized exchange. And then 4, wait until it falls in price. And then 5, rebuy X amount of the cryptocurrency and pay off your loan. The benefit of DeFi short selling is that you can profit from declining digital assets that are not supported on margin or derivative exchanges. As long as the asset is available to borrow via one of the numerous DeFi lending platforms, then you can short it. Now, bear in mind, borrowing digital assets via these platforms can be more expensive than margin trading, and there are DeFi-specific risks to contend with, such as smart contract exploits and also black swan events. So are you going to be going short? Let us know in the comments down below. That's all we have for this one. We'll see you guys in the next one.